Hello and welcome to Market Wake Up. I hope you're having a fantastic day. We've got a little bit to get into right now. It's just gone 8:30 a.m. British Standard Time. We are actually experiencing the Swiss National Bank forecasted to cut 25 basis points. So let's get into the intro. Let's get through it and let's see what's happening over in Switzerland. 25 basis point cut, John. 25 basis point cut, just printed there for us as we're going live. As you can see, I was a little distracted. I was looking at the print as we were going live, but what do you reckon?
Yeah, I mean, expected move, wasn't it? If we, think about what's going on in Switzerland at the moment, their GDP and things like that. Well, really, it's their inflation rate. Their inflation rate well below that sort of 2% target area at the moment, which is interesting. I think we're at 1.1 on the inflation rate at the minute, so well within their rights to continue to cut, I guess, at the moment. So everything seems to be going okay in Switzerland at the moment. Seems to be actually quite good situation going on there at the minute. So yeah, I'm expecting. Oh wow, it depends how the market takes this now, right? Because the Swiss franc has been strong for a while. I'll be interested to see what happens in the press conference. Obviously, we'll be going live while they're doing that, so we won't be able to see much coming out in the way of their press conference. But obviously, we had the Swiss National Bank chair before, just kind of talking about that they would intervene in certain ways if X, Y, and Z was happening. I think they've tried to weaken the Swiss franc with these cuts because the Swiss franc has just been very, very strong across lots of markets recently. So I think they're trying to do that, try and help their sort of trade balance a little bit, and it's not quite worked out to how they see things at the minute. I think even off of this data now, the Swiss franc is starting to gain some strength again in the very, very near term, I guess, just reactionary. So yeah, it'd be interesting to see how the press conference impacts this, whether they come out again and say something about, willing to intervene if the currency continues to get stronger. I think intervention words would be, again, sort of catalyst to see a bigger move from the Swiss franc. I still feel like the Swiss franc's getting weaker in what I've seen from just kind of like my strength and weakness analysis recently. We've started to see it come back against the likes of the pound, the euro, obviously Aussie and Kiwi as well have been outperforming the Swiss franc in the past couple of weeks or so. So there's a little bit of weakness, underlying weakness there. We've been talking a lot about some dollar Swiss upside as well. But yeah, I want to see it kind of continue to sort of break out of this little range that's been developed on dollar Swiss. If you look at the daily chart, it's just been ranging since sort of the 27th of August. So I need to see some kind of breakout there. I'm pretty sure we talked about the commitment to trade reports recently as well, where we've seen a little bit of a build up in those sort of short contracts from the commercials. If you look at a sort of Swiss futures chart. So it'd be interesting. Yeah, it'd be interesting to see how this one plays out. I'm hoping they come in and say we're going to intervene if it gets too strong. And that's what I'm hoping they say, and I'm hoping we get that uptick move because I like the look of dollar Swiss long, so that's where I want to be kind of positioning myself. I think I talked about last week as well, or it might be in the start of this week. Pound Swiss, I really like the idea of buying pound Swiss at the minute, and if that market can pull back a little bit, I actually wouldn't mind that because we're trading at sort of 113.20s at the minute. So if we get that down towards the sort of 112s, I'd be happy to try and look for longs in and around that area. So yeah, they cut. It was expected. Inflation well below 2% targets. So I think whether they hold here as well would be interesting. Whether they see 1% as the low, right? I know they've been lower than that in the past. So it'd be interesting to see where they see themselves now.
I'm almost convinced I could just leave. I've not had to say anything.
Sorry, mate. I've just literally watched for 5 minutes.
Someone, someone
up
tell
now.
me
I'll
that
shut up.
John's not been chatting to traders all week without telling me he's not been chatting to traders all week. No,
Yeah,
I agree.
literally.
Right, this was supposed to be a nice little warm settler to get into the show, and bam, you've been given his whole playbook. There you go, guys. He's he's looking for the Swiss bank intervention. He's just giving you everything he wants. But no, okay, beautiful analysis. I've got no points to add to it. You pretty much summed up the economic policy over there. The interesting points are the interesting points. I pulled up at the chart here in the background while you were going through there, just so everyone can see the immediate day trading reaction to the Swiss franc. You're right, strength. The immediate reaction was strength. Forecasted, came in as forecasted. There's no surprise factor here, so I'm a bit surprised that we're seeing the strength that it's having here, just in the volatility that is playing, because I don't think anything's a shock here. I don't think that's a shock. The press conference is going to be where I'm looking. That'll be on the hour. So just as we end our stream, the press conference will go ahead. What a better segue to send you off to some nice non-politicians talk politics. What more could you want? But Andrew's come and said shouldn't cut weaken the Swiss franc instead of US dollar. Swiss franc goes lower. Not necessarily. In a normal operating market where interest rates are all different, when you look at cuts, when you look at cuts, and when you look at why rate rises, oh my god, I really couldn't get those words out. When you look at cuts or rises, it is usually in comparison to what's happening elsewhere in the world. So if you're getting someone who's cutting interest rates and there's somewhere else that are rising them, then yeah, you'll usually see that outflow. Macro at the moment, the chart I shown yesterday shows you almost every economy is doing the same thing. So you're not going to get edge over the other economy because they're all doing the same thing. So you're not going to see the same usual reaction or macro reaction that you get from these cuts. And then a lot of people now are asking the question, why are we cutting? The Swiss National Bank, it makes sense to me. The inflation figures aren't great. The general economic figures aren't great. They need to introduce a little bit of stimulus in Switzerland. They have been doing that for a little while. If you look across other economies, this is where we like the question, why are we introducing stimulus? Do we need stimulus? But it isn't always that concrete, unfortunately. In terms of other market leftovers, at fear of Jon ranting for the next 15 minutes, I've got nothing else. I'm winding you up. There isn't much to report on yesterday. We talked about this in Freshly Squeezed. There wasn't much happening in terms of economics that were really worth diving in yesterday. Is there anything that stood out to you, or are we good to just flow?
I think we're just good to flow. I'm not going to take up all the airtime today. I'm going to just chill. You would have been proud of me last night, though. I'm going to take up a bit more airtime just to discuss this because I was having a few late night brewskis last night and got talking about sort of the markets and don't get me in that place. 10 beers in, do not talk to me about markets because I will rant for about an hour and a half.
I'll tell you what, we're going to need a special live event market wake up when we get a little bit bigger. We're getting because we've got a UK audience. We're getting to the UK. We're going to rent out a pub. We're going to have 7 beers and we're going to chat macro and we're just going to see where it takes us. The number one rule out there is never chat politics over a beer. And we're going to break it. We're going to cause some arguments. We're going to cause some fights, and it's going to be fun. But no, I'm interested to see what you got. Let's get into Freshly Squeezed. Barry, just to address your question, guys, we are doing this live. So if you have questions, make sure you throw them in. If you're watching this at a later date, we're live every day, Monday to Friday. Every week, Monday to Friday at 8:30 a.m. British Standard Time, where you can come in and ask your questions and share our analysis and your analysis too. Barry's just asked what sort of percentage is good for a seasonal play. I'm assuming you mean the percentage of like the win rates, not necessarily the average percentage return. A lot of percentages in seasonal plays, so I'm going to question you there, but I'm going to assume you mean the win rate. Anything below 60, I don't care about, unless it's below 40 or below 30. If you look in the opposite, even in and around the 60s, the low 60s, I'm not too fussed. It depends on how much data there is. For example, if it's a 60%, but it's over 40 years, or 68%, it's over 40 years, I might be like, okay, well, there might be something here. If it's a 68% and it's sitting in and around 7 years of data, it's gone. I don't care about it. You're actually talking about profit target. That depends on the asset you're trading, my friend. currencies are going to move 0.2% on average. Yeah. Stocks are going to move 20% on average. That just depends on the currency and your risk management plan. Let's jump into what's been happening recently. Let's jump into where prices are currently and what we can expect throughout today. I'm so excited for my big bite today, John. I am very excited for my big bite.
I'm excited too.
You picked this up today and I'm excited. Yeah, this is one of those analysis I've done and I've come out of it and I feel so proud. I feel really proud of the analysis. I know. One of those ones I'm backing and I'm willing to share. It's not started yet. That's the beauty of it. It is actionable analysis in the big bite today. So if you guys are excited for it, make sure you hit that like button to help us get out there and to share the word with everyone else as well. But for now, let's get through where markets are priced at. The VIX down at 1508. Come down a little bit again. Gold continues higher. It's quite impressive to actually see how much green is on the right hand side of my screen right now. It is an interesting one to have a look into. So to start us off, let's look at the Aussie dollar up 0.5%, euro up 0.15%, the pound up 0.2%, US dollar CAD down 0.07%, and US dollar Japanese yen up 0.25% so far today. The XJO or the Oz 200, we're looking at up 0.7%. The DAX is up 0.5%. The Nikkei is up 2.08%. Sorry. The FTSE is up 0.5%, and the S&P 500 up 0.7% here in pre-market. Coffee up 1%. Gold up 0.25%. Nat gas up 1%. Silver up 0.8%. Sugar up 0.5%, and oil down 2.6%. Bitcoin up 1%. Ethereum up 1.7%, and bonds pretty much unchanged. But I've said up 1%, quite a lot there. A little bit going on. One chart that I really, really like, and I just want to point out to everyone at home, is my favorite one, sugar. That sugar play, I made a short on it today. I'm sure you would have seen it. That just made me proud of myself. Okay. Of the clip of the stream on the 2nd of September, we did a stream where I brought the sugar idea and we were trading here. All right, 2nd of September, where are we? It was in and around here. And I said, what I would really like, and I've clipped it so we can see it just because I want to toot my own horn. What I'd really like is this to drop down to the trend line and then go higher for this seasonal play with an average return of around 9%, with some of the good ones returning over 20%. Oh, my word. It nailed it. It's so rare that we nail it. Right, because its probability of nailing it is so rare. But the seasonal play was just sexy. The technical play lined up. We pulled back up over 25.4% since that analysis, which is just fantastic. But yeah, look, that's where you're priced in today. There's a little bit to look forward to ahead of today. We're moving, obviously, into the Swiss National Bank press conference coming up in about 17 minutes, which is going to move the Swiss franc a little bit more, arguably more than what the actual rate cut has, in my opinion. Then we're moving into GDP and unemployment claims coming out of the US. GDP expected to stay the same quarter over quarter. Unemployment claims, though, expected to rise up to 224K. We know how big the revisions have been with unemployment claims recently. You got any biases moving into this GDP and unemployment?
Zero, nil point, no biases at all. Just it's again, I think the market is just sitting, it's holding, it's waiting for bigger catalysts at the moment. Obviously, I think I favour more or lean more towards sort of the unemployment claims. Obviously, GDP, this is the final GDP, so this is going to be the one that's sort of concretes it. But essentially, it's up at 3%. That's quite large in the US, right? 3% GDP is quite big, and if you look at that if you were kind of just looking at GDP sort of differentials across the board, right, that they are absolutely smashing everybody else when it comes to GDP and growth, right? So it kind of makes you wonder, this dollar weakness that we're seeing, sorry, just punched the mic there. This dollar weakness that we've been seeing in the market, whether that's going to come to an end at some point, and whether it's going to actually change quite aggressively if the market has been pricing in what they've been pricing in, and it's not. they're not getting what they expect. Because I just think I was looking at sort of all the sort of economic indicators that you typically look at yesterday, and I was looking at sort of, obviously we know the interest rate situation. They're bringing interest rates down. We know that. They're going to continue to do that. But when you look at sort of it from the differentials, they are still higher than most other markets, and that can be a positive thing, but it just kind of depends on the pace now of how they cut and where they kind of see themselves with regards to the sort of global market. Then you got GDP, like I've already said, was way higher than everybody else's. So yeah, it's really interesting to me. I actually did a little piece of this on sort of euro US dollar that we'll share on socials. If you want to go follow us on socials, LinkedIn, Twitter, we'll post it on socials as well, because I talk about that GDP differential in there and how you can use it within sort of finding ideas and stuff. So go check that out. But yeah, GDP I think will be important today. I am still leaning more towards the sort of labour market data. Obviously, we've got Fed Chairman Powell speaking today as well, so that'll be quite interesting. I don't know where he's speaking or what it's for.
Not just him either. You got the whole board.
No.
And what I find interesting about this is a lot of the reports I'm seeing, and there's a take that, to be honest, I didn't pick up on, so don't give me the credit for this, but a lot of the wording that has been said and the reaction to Jerome Powell's cut of 50 basis points is leaning towards this was actually Jerome Powell cutting and not the Fed. The Fed don't actually love the idea. It looks like Jerome Powell's bullied his way to this decision of a 50 basis points, which is really interesting. So we've got Jerome Powell's speech. We know what he's going to say. You mentioned the other day, it might have been yesterday actually, the confusion in what he was saying. Like it just was unaligned. Yep. And I've done some more digging. That's what I like about the show is we challenge each other. I've done some more digging on that and watched the press conferences and really honed into it. And you're right. There is no ounce of what they were saying which showed clarity. And to me, that shows lack of control. That shows lack of control. It means they're being reactive. And we discussed this. Are you being reactive or are you forecasting? I don't think they have any idea where this is going to go. They're being reactive, and that there isn't a clear line on where to go. And I think that confusion between them, saying the jobs market is nice and steady, and then you look at their forecast into late 2025 and you go, what do you mean it's steady? You're forecasting the jobs market to be an absolute tip. Like, how are you going to say it's running steady and that's why you're doing cuts if you're forecasting your own company's forecasting it to be rubbish? You're right. There's a lack of communication. And you don't want that from your central bank. You want a clear cut path on where you're going. And right now it does look like there's a lack of control. So I'm eager to see actually what the other FOMC members have to say. I know that's one thing the calendar's not going to highlight for everyone to be like, oh, Jerome Powell speaking. I don't really care what he's got to say at the moment. I want to know what member Collins, Kugler, Bowman, and Williams have to say, because I want to know if one of them want to take this opportunity of weakness to have a bit of a jab or to see kind of what's going in there. But without further ado, sorry.
Sorry, no, I was going to butt in and start talking for 5 minutes again. You carry on.
Well, you can do it too much. We need an extended version. Maybe this show should go for an hour in the future. But look, let's get into the big bite. All right, let's change this up. Let's get the music changed up. Let's get in the mood. Okay. Let's get serious. Big bite today is coming at you with commodity. And I know Barry's just asked about lumber. And Barry, I do actually confirm your suspicions of that. We'll get into the numbers if we have time at the end. But yes, you are right. There is a nice seasonal play with lumber in towards the end of the year. Today, the commodity I want to chat about are soybeans. I want to chat about soybeans. I know, a little bit out there.
Soybean market.
Little bit different.
You know how like you despise gold?
Yeah.
I despise soybeans.
What, like the trading asset or the taste?
Oh no, the trading asset.
Why?
So when I first started trading, soybeans was one that for whatever reason, was just like the first sort of commodity that was up there on Trading 212 when I opened up the app or whatever. And got absolutely handed to, put it that way. So I've never touched soybeans ever since.
Well, let me change your mind.
You're going to change the curse. You're going to break the curse.
No, I'm not. I'm going to let you avoid soybeans, but I'm going to let you make money from this analysis on soybeans. And I'm going to show you, because the good thing about this big buy is this analysis is on soybeans, but how we execute on it, I'm going to give you 3 different ways. And that's going to be the beauty of it, right? So looking at soybeans here, it's had a horrible 2 years. The reason it's had a horrible 2 years is because in pretty much South America and Brazil in particular, the growth that they're seeing there, the weather conditions, plus the amount of new farmland that they are creating, they are overtaking the US in producing soybeans. So it's this massive amount of supply coming to the market, which inevitably has seen this downfall here in soybeans and moving through. But one thing that has always remained strong is a seasonal play. A seasonal play in a commodity asset, which is driven by harvest seasons and trading and moving around because it's all weather conditions. And that's where seasonal plays stand out more. Diggs, welcome in. I want to talk about the seasonal play in soybeans, right? So before I kind of throw it anywhere, I'll just chuck up the Season Axe tool here. It's a 72% win rate over 33 years. And we're looking from the beginning of October towards the end of December, almost exactly to Christmas, okay? An average return of 5.2%. I think we can go bigger this year, and I'm going to explain why. But as a whole, this is a great little seasonal play to start with. 72% is on the lower side of what I like, but it's over 33 years, which I do love. I was scavenging through, having a look at the different percentages as we do. We dive into it, okay? And then I thought, you know what? Let's do what John would do. So what I did was actually, I got away from Season Axe and I went on Markets Make Clear. And let's do what John would do. And I did a couple different things, okay? The first thing I did was to have a look at the correlations. The seasonal correlation this year so far is sitting at 79% for all years. And this on the seasonal analysis here on Markets Make Clear goes back to 1960. So like a 79% correlation with all years between now and 1960 is incredible. That really is incredible. And so then I went and threw on a custom out there, which is if September is positive, which is what we're getting, which is rare. September being positive is actually quite rare for everything. September is usually a negative month. We're even going to get positive in stocks, which is just ridiculous to say. Is quite rare. The correlation isn't as good. The custom correlation comes into 59%. However, if I go ahead and get rid of the all years one, have a look at what happens from September all the way into December for the years where September is positive. This is the blue line on your chart. I'm pointing with my pen like you can see it. You can't. Sorry. Here's my mouse. This is the blue line here on the chart when September is positive. They bottomed pretty much at the same place. What we have seen so far this year compared to all those years, and it is a fair few years. This isn't just a small handful. There's a fair few collected in there, right? Really, really positive. So I'm like, this seasonal play, I do like it. I understand why it's been shorted heavily. I understand that obviously the seasonals and the growing seasons and stuff have been very beneficial. Nevertheless, I do like the bounce. I do like the idea with going higher. The bottom down here is a correlation line. Can you take a guess on what I'm correlating this with?
Gosh, I don't know. I was gonna say for some weird reason I was gonna say yen, but I don't know why. That wouldn't even make
You're addicted to the yen
whatsoever.
You've got a problem.
To the yen. Yeah.
The Brazilian real. The Brazilian real is what I've correlated to, with Brazil being one of the largest producers of soybeans. At points over the last 5 years, they have been the biggest producer of soybeans. There is a very, very negative correlation with soybeans, okay, with the US dollar Brazilian real chart. What that means with if soybeans prices goes up, the demand for the Brazilian real goes up. Therefore, US dollar BRL drops, right? this currencies is what we're talking about here. And this correlation is shown here down the bottom, predominantly sitting towards that negative side. There's a few times we've popped up, but every time we have popped up, it tends to be in and around ranges. So I'm happy with that. If they're uncorrelating while both assets are ranging, so be it. Uncorrelate. It's when we're moving, that's when we move. Andrew says, when in doubt, yen. It's very much what John's feeling right now. But so my play here is soybeans long. Very simply, I like the idea of longing soybeans into December, which is predominantly driven by that seasonal play, which I have had great success in so far this year with commodity seasonal plays. So I like that anyway. But to add to the analysis, I also like the idea of shorting going long on the my head. It's just completely lost me.
Brazilian roll?
Yes. Sorry. I'm getting caught up in. I like the idea of capturing the soybean strength across a number of assets. Okay, that's essentially what I'm trying to get. Now, from a technical perspective, soybeans is heavily shorted, so you're just going to look about maybe fading that in. A lot of people are going to be caught up in doing that. But if you have a look at US dollar and the Brazilian real, you can see we're actually, which is the purple line here, we're actually testing some all-time highs. We're testing some areas here. Now, if we do get a very strong bounce in soybeans, which will increase the demand of the Brazilian real, we could actually find some interest. The problem with this is you've got to short the US dollar. You've got to short the US dollar, which we're not big fans of right now, right? We're not. We're actually looking for a bounce in the US dollar. However, in the event that that's not working out, we've got two ways to trade it. We can capture the soybeans move directly on soybeans and have fun with it, or we can capture the Brazilian real up against the US dollar, or we can do both and we can hedge it and have a little bit of fun. But those are the three options there. The long-term kind of view I'm having here is long soybeans into December, because the statistics in which they're showing the average return of 5.2%, but you can see in here there's been years where we get way up into the 15s, even into the 30% with gains. 2020 is a great one of 22% there. 2021, 9%. 2022, 7%. Last year, only 0.7%. But I do think with how heavily we've been shorted, we can get a little bit higher. Or you can extend the analysis and trade on the currency if you're more comfortable backing it against something else. Or you can do both. What do you think?
I like it. And to kind of back you up here, I've actually just been on the side. So it's quite funny on the side. I actually went onto Markets Made Clear and just had a look at and I put if September is positive, and then you started talking about it. So I was like, oh, okay. And then I've had a little look at the commitment of trader reports, and there was actually a bullish signal on the commitment of trader reports towards the end of August. Now, long contracts from the commercials are pretty much nearing all-time highs, right? So the most amount they've been long ever, right, in soybeans at the moment, which is interesting.
And is that
obviously
a positive sign or a negative sign?
That is a positive sign because it's an extreme, right? So they're buying it at extreme levels. When I look at what the non-coms have been doing, they've been shorting very aggressively as well, and they typically do that towards the end of a trend. So yeah, I like this a lot, because if we do see that switch around now from a commitment trader point of view, that tells me that hedge funds maybe are going to start reducing those short positions, and they're going to start backing soybeans. Long contracts haven't really upticked too much, but they've been heavily short, so you're not going to see that. It's a lagging indicator on a week by week basis. So, but it'd be interesting to see how that performs next week. If we see a significant drop in short contracts, then it tells me that maybe they're just reducing those short positions and could be starting to flip those positions. So yeah, I like this. You got seasonal play, hedge funds kind of backing it.
Yeah, awesome. All right, well, let's do 1 + 1 = 0. Executor, I've done my best to convince you on getting long soybeans there. I'm going to quickly just touch. We are going to go a little bit over time, and Rich is going to be upset at us. So when you guys go over to Rich, just make sure you say sorry. But it's just because I'm excited about a couple of things. One, this is the first time we've ever had an audience member bring us a seasonal play. And I just want to highlight that for a second. I am incredibly proud of us and incredibly proud of you, Barry. Thank you for doing this, because this is something we discuss and we want your guys' input as well, not just to present, but to build the community. And the fact that you've just come in there and brought it. What I will quickly do is show you what Season actually showing me here in Lumber, looking over the past 25 years. I know you're looking at 20 and you've done it manually. I'm going to go ahead and speed it up. You're right. Now, November seems to obviously be the big climber here. You can see in and around here, highly driven by 2009 and 2021. Not sure how I feel about that. 2021 being post-COVID outbreak, 2009 being post 2008 financial crisis. I'm not sure if that has any play in what lumber is doing or how it moves. Average return, if you are looking from the beginning of October up to late December, 64% win rate over the past 25 years with an average return of 10.2%. You've got a minimum 2% rise. I'm telling you here, over 25 years, the average return is in around that 10.25%. And then lastly, that I want to touch on, John, is what on earth you were doing last night when you were drinking, because I really want to know.
No, it's interesting, isn't it? Because I was just drinking away and we were just talking about sort of everyone kind of goes, oh, you're in this, right? What's going on at the moment or whatever? And that's typically the question that you get asked. And then I started going on a rant about sort of the Federal Reserve and the way they've cut in interest rates, and it's going to impact X, Y, and Z. This is what I think is going to happen, blah blah blah. And then obviously it just rolls into other stuff. I mean, I ended up just talking about The Big Short as well for half an hour because I love that film. And so,
all right. That's enough. I am eager to know your thoughts, but we'll touch base tomorrow to get that out. Guys, if you did enjoy this episode, make sure you hit that like button. After the stream, leave us a comment as well. It really helps. If you've got some seasonal analysis you want us to review, you want to talk about, you even want to share to get our opinion on some trade ideas, make sure you're sending them out. Barry's just mentioned there, he's got a few stock ideas as well. 100% get it over. Guys, thank you for watching us. We'll be back tomorrow, Friday, 8:30 a.m. British Standard Time. We'll see you in the morning. Cheers.